Welcome to the next episode of Wealth Strategies to Value. I am your host, Troy Shorts. It's a pleasure to get back in touch with you guys. I got a special guest today, Lesley Batson, that will be here to discuss some important information with us. I want to just give a brief introduction. I've met Lesley probably a year and a half ago or so. We are connected by a financial planning group where we work hard behind the scenes to really educate the public about how wealth truly works. And she is like a superstar in our industry. So I had to have her come on. Lesley has been in the financial services business for about 4 years or so. And guess what? She used to be an IT professional. So she used to be just like you. And what happened was Lesley was introduced to some concepts in the financial services industry that really changed her life. So now she's out marketing, talking to people, educating people about how what we call the IBC works. IBC stands for the infinite banking concept. So with no further ado, I'd like to introduce Lesley Batson.
Hi, Troy. Hi, everybody.
Hey,
Thanks for having me.
no problem. So Lesley, I would love for you to share with my listeners really what IBC is, and tell me how it's changed your clients' lives. And I really want you to kind of go into breaking down some of the myths about infinite banking.
Okay, sure. So, once again, thanks for having me, Troy. I'm glad to be able to share with your audience some of the things that I've learned and what I share with my clients, because I do think it's important. There's a real gap in what I call financial education and financial marketing. And
Mm,
unfortunately, too many of us are exposed to the marketing and we take a lot of it for the truth and we take a lot of it as financial advice. But we don't always understand, the full context or everything behind what we're seeing. And because we see some of the same, recommendations or the same things over and over again, we take that for the gospel, and it's just
yeah.
not always true. So for me, just to tell a little bit about myself and how I got into IBC. So as Troy mentioned, I was an IT professional. I was doing consulting for, Fortune 500 company. And I was really kind of getting burnt out. I was just thinking, like, there's no way I'm going to be able to do this for another 20, 30 years. Like, I've got to figure out something else to replace my income. And so at that time, I started to seek out real estate investing. So I had done some of it, before when I was living in Chicago, but I kind of moved away from it. But I wanted to get back into it at a higher scale so it could truly replace my income. So I was listening to podcasts and I was listening to this one particular podcast, and he had a guest on and he was talking about how you can use whole life insurance for like benefiting your investing. And I just could not understand what he was talking about. I was like, first of all, I've never even heard of whole life insurance, and that's how ignorant I was. I was
Yeah.
very familiar with term insurance,
Hmm.
term life insurance, but I didn't really understand what whole life insurance was, why I would get it. I didn't have any kids. I wasn't married at the time. I was just thinking, why would I want life insurance? So,
Hmm.
but he was saying a lot of interesting things. And I thought, okay, I need to just understand this a little bit more. He himself had a podcast. I went and listened to his podcast, and where he had way more information all about this infinite banking concept. And so I reached out to him. I got a policy. I said, I really want to learn more about this. I don't understand why more people don't know about it. He told me how I could become an authorized practitioner. And that's kind of where my journey started. And so I'm now at the point where I've fully transitioned out of IT consulting, and I'm doing this business full time, sharing this concept with people and helping them implement it for themselves and their businesses. Um, so the infinite banking concept, it was started by Nelson Nash. He wrote a book in 2000, year 2000. He's no longer with us, but he wrote this book to try to explain. It's a very short book. It's not even 100 pages. So I tell people, please go out and get it. It's called Becoming Your Own Banker. You can get it on Amazon. I have some copies if you want to reach out to me. But it's a very crucial book, less than 100 pages, but it really will it's a paradigm shift in our thinking. Um, and he has many fundamental principles in there, but one fundamental principle that I like to kind of emphasize with people is that we finance everything, right? If we pay for cash, we think, okay, I'm not financing this thing, so I'm not paying interest. And it's true, you're not going to pay interest. However, the dollars that you pay cash they've lost the opportunity to grow. So there's that opportunity cost that those dollars were used one time, they're sunk, and they didn't have a chance to grow over time. And then when you do finance something, then you are paying an interest. There is a cost when you're paying the interest. So everything we do, we're financing it. Everything we purchase. So what Nelson tries to explain in the book is, if you have to finance everything, what is the best way or the most strategic way? What's the least costly way for you to do it, and still have some other benefits? And so what he talks about is the product is whole life insurance, but the strategy is infinite banking. And so one example of this is when we talk about, people who are looking to say, and the priority is leverage, right? The strategy is really around leverage. And so a lot of people, they've built up equity in their home and they think, okay, yeah, I should get a home equity line of credit and I can use that to whatever, right? Pay bills, invest in another property, whatever is the purpose for doing that, because they understand that they have built up this equity in their home and they can leverage it. Now, a whole life insurance policy is different, right? It is an asset, right? If we think about our homes, we always think of them as our homes because we live in them. Our name is on the title. However, we've signed a mortgage note with the bank. And so really, until that note is paid off, it's really not our asset, right? And in a lot of cases, it's a liability. Now, that asset may have appreciated over time. And so we've built up some equity in this home. And so we decide we want to tap into it. I have a client who I was just sharing with Troy this week. And so I thought I'd share this story with you. So he was explaining to me how he bought his home cash, his primary residence cash, a few years back, and it has appreciated so much that he recently he qualified for he took out 200,000 in equity. So he used 100,000, a line of credit, used 100,000 to buy an investment property cash. He used the other 100,000 to pay down on another investment property. So I was explaining to him the difference of, how he was using that money. So I asked him first to explain to me, how did he access the equity that he had, was in his home? And he didn't really understand what I was asking, but I said, no, just explain to me, what really were the steps that you took? He's like, well, I, contacted the bank, I was like, yes. He's like, so I contacted the bank. I completed an application form. They ran my credit, went through underwriting. They got back to me and, told me what the amount was. They told me the terms. So meaning how much they were going to, lend me that money for, and what the terms were for me paying it back. And I was like, okay, so the bank really made all the decisions, right? And he's like, I guess so. I'm like, well, they did, right? They decided if you could access that equity, how much of that equity you could access, what their terms were for you to pay back that equity. So was it really your equity? Is it really your money, or is it theirs? And he paused and he realized, wow, she's right. That's really the banker's equity that I'm believing to be my own. Yes, I'm able to tap into it, but I have to first follow all these steps. And I said, by the way, we know that, at the time of this recording and actually today, the Fed has officially increased the rate by 0.25%. And they're, promising to continue to do that. Yep. I said, so I can almost guarantee to you at some point this year, if not immediately, that interest rate is going to go up on your line of credit because the bank they have the ability to do that. Right. Yep. So he was just thinking like, oh, okay, yeah. So I really don't have a lot of control over this money. So then I explained to him, now, if you have a whole life insurance policy, that truly is an asset, is a personal asset that you own. The premium payments that you're paying into it, over time, you're building up cash value inside of that. And that cash value is the equivalent of equity that's building up in the policy. And let's say that you now want to, borrow against the equity in that policy. You don't have to fill out any applications. You don't have to explain to anybody what you want to use that money for. You don't have to, no one's going to tell you when you have to pay that money back. You have a lot of flexibility. So if you're choosing, in his case, he's wanting to use it for an investment property. So I said, okay, so maybe in those first few months, you've got to, fix the roof, paint, buy furniture, whatever it is, because he's doing Airbnb. So whatever you need to do with that money, you have the access to do it, the ability to do it. And maybe, 6 months down the road is when you first, get your first tenant in there, whatever it is, you get to choose when and how much you want to pay back the loan. So it truly is your money because you have full control. Now, you're not borrowing your money. Your money gets to stay in your policy and it will continue to compound and grow and build up cash values. You're just leveraging the equity in your policy. So you're actually using the insurance company's money. So they will tell you, what the rate is to borrow their money, but otherwise you have full control over the terms. And they will not let you borrow more than you have in your cash value. So that's, where they have some say as well. But that's it. Otherwise, it's your money. You can get to it when you want to, and you don't ever have to touch it if you don't want to. But when you do, if you leverage it in that way, it can really accelerate what you're trying to do from an investment perspective. So while your money is continuing to grow in your policy, you've leveraged it for this next property. Those cash flows are coming in from that. You can use those to pay back that loan, and you can rinse and repeat. If in another 5 years or another 3 years, whenever you've paid that one down, you want to get another property, you have the ability to do that. And so that's where that infinite comes in with the infinite banking, because it's really, you can really do it over and over and over again. That $1 that was sunk when he purchased the one property with $100,000 cash. Great. He has no mortgage. He doesn't owe anything on it, but those $100,000 are sunk. They're gone. There's no more that he can do with those dollars. But with if he had used a policy for the down payment on the other property to borrow, when he pays back those dollars, he could, basically reuse and reuse and reuse and recycle those dollars. So
Awesome.
It's really the simplest way that I could explain, the difference between borrowing from a true asset and borrowing from really an asset that belongs to someone else.
Wow. Listen, I want to just say you did an amazing job of making something that can be so complex very, very simple.
Thank you.
The purpose of this podcast is for financial literacy.
Yes.
And I think, it just like you, as a lay person prior to being in the industry,
Mhm.
the information and the knowledge that you received literally catapulted your life.
It did.
And now you're in a situation where you can transfer that information to the public and catapult their lives.
Yes. And thankfully, I've been able to do that, right? I think like the perfect example, and we both know this from our coaching, but the 401k, right?
Yeah.
From the time before I graduated, if I had heard anything about money, it was a 401k, and that I need to put as much in there as quickly as I can, and as every year until I retire. So
Yeah.
try to just stuff as much money in there as you can, because that is your retirement fund.
Yep.
In my mind, I thought, wow. And of course I was like, 23, 24, but I was thinking, okay, this is like the only way I'm going to be able to save for retirement, And of course they also talked about the tax benefits of, putting your money in, so you don't have to pay those taxes this year, you're putting them away. And so I really bought into that, so I thought, okay, I should be maxing out my 401k. And today, most people still believe that the 401k is the holy grail of retirement.
Yeah.
But the one key thing that I never understood, two key things. Number one is the cost of having a 401k. I had no idea I didn't have a full understanding of the fees that, the cost of having a 401k. I never thought about, okay, my employer has to pay a cost to actually have this plan available to us as employees. I was aware of, like, say, the expense ratios of the funds that I was invested in, but I didn't really think about it. I'm like, okay, 0.5%, 0.8%, that's nothing. You just think that's really nothing at all. But you don't realize how that's actually eroding your growth over time, right? We can't forget the time value of money. So the cost of having a 401k, thinking I had more in that pot at the end of the journey than I did. But then the second crucial part was the taxes. So yeah, okay, I save the taxes this year, put them in, and they're in this 401k plan, but I didn't really think about, oh wow, as the balance in my 401k is growing, so is the amount of taxes I'm going to have to pay. So I actually was creating this ongoing, uninterrupted, this compounding tax bill for myself that was going to be, building up over 20, 30, 40 years for however long I keep that money in that 401k plan. And so
Yep.
that's something I've been able to help other people understand. I've been able to kind of show that. And, just like I did, their eyes kind of, pop out of their sockets, like realizing, whoa, whoa, whoa.
Yeah.
What's been explained to me is not at all, what the truth is, So
Yeah.
most people really don't think about when it's time to take out that money, how much am I going to actually have left at the end of the day? And that's kind of
Absolutely.
heart-wrenching. So it's been good to be able to
Yeah.
show them different ways, alternate ways to save for the long term.
Yeah.
Hmm.
Wow. I mean, I'm in full agreement. I mean, I feel the same way when I talk to people about those particular accounts, and it's like, you know, we are so smart, but we're so not smart. you know,
Yeah.
uh, we have to understand that the financial institutions and the government and the banks are pretty much in cahoots against the public, and you know, people have blind faith in their bank. They have blind faith in their mortgage company. They have blind faith in them on Wall Street,
Hmm.
and those people have no mercy. they have
Yeah.
their job is to take our money. Period.
They're
Like
very creative in creating ways to do that, right?
absolutely, absolutely. So, like you said, a little bit here, a little bit there, a little bit here, a little bit there over a long period of time are
Hmm.
dollars that the public is literally forfeiting unknowingly and unnecessarily. And one of the strategies I know that we talk about is, how do we recapture those dollars?
Hmm.
How do we move some of that money back on our table away from them,
Exactly.
and allow us to do the things that not only we need to do, right, but do the things that we want to do.
Exactly. And have the freedom to do it.
Yeah, absolutely. So, listen, I just want to recap a little bit what Lesley said. That I wrote some notes down as she was talking, but um, you know, I think one of the key points that you hit was we finance everything, right? People don't understand that. You're a borrower when you're young because you have no money, and then you
Hmm.
have to pay this interest rate back, right?
Yep.
And then once you get a little savvy, you're thinking to myself, I'm not going to fall for that anymore. I'm going to save my own money, right? I want to save it myself, right? And as soon as you stroke the check, you lose the opportunity to invest and save that money for the rest of your life. So that
Yep.
is so important. That's foundationally important. And when you're a wealth builder, right? A wealth
Hmm.
builder can use infinite banking, where
Exactly.
where you're using the insurance company's money, and your money compounds uninterrupted for the rest of your life. That's what
Absolutely.
wealth builders do, right?
That's what they do. And they understand the importance of cash flow, right? Liquidity and cash flow.
Ooh, that's my favorite word. Oh,
Yeah,
that's my
two
favorite
really
word.
key
Uh,
key points, because if we don't have
yeah.
those, your money's always tied up, and then you're forced to have to reach to more expensive means to reach to be able to get, to leverage or to use for whatever you need to get done. So
Yeah.
let's say all your money is tied up in something like a 401k, or even if it's tied up in investments and you don't have enough
Mm-hmm.
savings, well, now you're leaning on a credit card that might have 10, 15, 20, 25% interest,
Yep.
because you don't have liquidity. So
Yep.
having cash flow is, and that's a whole probably another separate podcast, but
Yeah.
but
Yeah.
yeah,
Yeah.
there's so many different reasons why you want to make sure that you have liquidity, that your
Mm-hmm.
money is somewhere accessible,
Mm-hmm.
um, and it's, able to be somewhere where it can still earn some money more than what it's going to earn at the bank, but you also have some flexibility and some privacy. I think that's probably one of the
Mm.
other key things that, especially some of my higher income earners, they
Yes.
definitely like the fact that, the money that's in your policy is private.
Yeah.
So each year when you file your tax return, you do have to file a 1099 for your 401k, your
Yep.
Roth IRAs, all of
Yep.
that, because those
Yep.
are IRS controlled accounts.
Absolutely.
But your whole life insurance policy is your own private asset. Whatever cash value you've built up in it, whatever loans you take out from it, that's
Yeah.
all your business between you and the insurance company. The
Yeah.
IRS never needs to know, or any
Yeah.
other creditor besides that. So,
Yeah. Just to add on to that, privacy is very important.
Hmm.
But the other thing for our high income earners, well, even not so high income earners, it's suit proof.
Yes.
It's suit proof,
Yeah.
right? We
The
live in the
predators
most
can't get at it.
litigious society in the world, right? Well,
Yeah,
guess what? They can take your money, but this money they can't take. It's
absolutely.
it's what I call, close to the vest, right?
Right. Exactly.
And it allows you to keep your money in the family, right?
Exactly. Exactly. And
The
I think that's really one of,
Rockefellers, they
yes, I was going to say,
right? They kept the
there's
money in the family, right?
generation to generation. This is the
The,
type of money that can last and last with a true benefit for everybody, right? Because
absolutely.
we've been talking about the living benefit. So how are you able to take advantage of it while you're alive? But when you pass away, that death benefit is going to go to your loved ones, income tax free,
Yeah.
and and immediately, right?
Yeah.
There aren't
Yeah.
any restrictions as to like say with a IRA or something like that, they've got 10 years to pull that money out.
Mm-hmm.
Okay, so they are now having to pull it, even if they didn't need it, they're having to pull that money out. And if you've built up a substantial balance in your IRA or 401k, that when they take it out, it's going to add to their income for that year. So what does that do?
Exactly.
Possibly, it may possibly push them up to a higher tax bracket.
Yeah.
Is that really what you wanted? You really wanted Uncle Sam to get more of that money than your own, loved ones? I don't think that's what most people, intended. So you really
No.
have a lot more control with making sure that your family or whoever you choose to designate it to, that they are the ones who get that money, as
Yeah.
much of it as possible.
Yeah. As we're talking about living benefits, I also want you to touch on what happens when people have money in whole life insurance and they get old and they get sick. What happens? How does that help them?
Right. So two things. They may not even be old, quote unquote, right?
Right.
But they could get sick, right?
Yeah.
It's not unusual for people in their 40s, 50s, 60s even to maybe get cancer, or just, there could be some illness that unfortunately befalls them and they're not able to work for a period of time. If your policy is structured properly, there's a rider called a disability waiver premium, and that can kick in to keep up your premium payments on your policy to make sure that that stays intact and you're able to focus on your recovery and getting better. And if you need to, you can still tap into your cash value to use it if you need it for medical bills or anything like that. And that's not something you're going to get with, putting money into a 401k or anything like that. No one's going to step up and start contributing on your behalf. Okay.
Exactly. Exactly.
But later on in life, it typically is later on in life, if you need any kind of assistance from a nurse or you need to move to a nursing facility, anything like that, you also have that benefit to tap into your policy to use towards that kind of long-term care. So there's really a long-term care alternative. Now you may even just get a specific long-term care rider that is, specific for long-term care insurance and can be applied in that way. So there's different features that are available, but tied to a whole life insurance policy. So the premiums that you've been paying in over the years are going towards multiple things, right? It could
Mm-hmm.
be towards helping you with that long-term care. It could be towards a rider that's going to be able to kick in if you get sick and hurt to keep your policy premiums going. Like we've talked about, being able to tap in and use that cash value for investing or for an emergency, anything. It's really an emergency and opportunity fund is really what I think of as your cash value while you're alive.
Mm-hmm.
So those dollars are really able to do multiple things, as opposed to if it's sitting in another type of account, it typically has, one opportunity to work for you.
You got it. Listen, you're touching so many things. Like my head is just spinning right now because I'm thinking about all the conversations that I've had with my clients about these exact same things.
Hmm.
Traditionally, when you talk to people who have traditional planners talk a lot about rate of return. And they
Yes.
may boo-hoo this strategy. And they say, well, you can't make any money doing that. There's no rate of return. Da, 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 da. But what you've brought to my attention just in our brief conversation is what's the rate of return on having accessibility to my money, right? What's the
Exactly.
rate of return with having the ability to use leverage to leverage the insurance company's money to put it somewhere where I can make a ton of money, right?
Exactly.
What's the rate of return on the fact that I know if I get injured, if I get sick, if I need long term care, there's going to be a benefit there to provide for me so that no one will take my assets. Like
Exactly.
like you said it, my $1 allows me to do 3, 4, 5, 6, 7 different things.
Yep.
and
Exactly.
and it's sad to see sometimes when I look at these blogs and I look at these articles and these people are boo-hooing this stuff. They're saying, "Oh, that's the worst investment you could ever make." And I'm thinking, what don't you understand? Like, who lied to you when you believed it? Like, you tell a lie a thousand times. Well, after 1,000 times, you believe it,
Absolutely.
right? You think
But
it's the
you hit
truth.
on it though, right, Troy? You hit the nail on the head. People are out there calling it a horrible investment. It's a horrible investment, but it's not
It's
an
not an
investment.
investment.
It's a savings
Exactly.
vehicle, right? Just
Exactly.
like I mentioned, a lot of my clients are real estate investors. So they have a lot of money tied up. It's like locked up, unfortunately. I mean, it's great. They're going to make a great return on it, but it's locked up. They can't access it, right? It's
Right.
locked up in these investments for sometimes 5 years, sometimes more. So
Hmm.
what does that mean? If there's some type of emergency, they don't have any liquid savings, right? You need to
Yep.
have reserves.
Yep.
When they do sell that property or whatever they're doing with that property, they get a big, let's say a big windfall.
Hmm.
Where are they going to put that money? In the bank earning 0.01%, or in a policy where they can earn way, way more? And again, know that it's liquid, it's accessible. They can quickly tap into it. They don't have to fill out a application for a line of credit, like all those kinds of things.
And
If
it's
someone's in
tax
there
exempt.
and it's tax exempt access to your money. We haven't even mentioned that, right?
It's tax
And
exempt.
that's probably one of the greatest things, right?
Yeah, I talk about that a lot.
Yeah,
When you come into the windfall, what are you going to do with the money? And people will
yeah,
say, "Oh, I don't know." Well, if we can show you where we can put that money where you'll never pay tax on it again for the rest of your life, is that something that you want to do? Well, yeah. Well, what is that? Well, what could it be? It could be
yeah,
cash value life insurance. Wow, I
right.
didn't know it worked that way.
Yeah. But
Well, it
most people
does.
don't know that because out there, they only hear about life insurance for the purpose of the death benefit,
Correct.
right? They don't understand all the different ways that it's actually a tool that can be very, very, if used properly, it's very strategic and able to help people save a lot of money in fees and taxes and the privacy, like we mentioned.
Hmm.
I think the other key thing is that, when we think about, again, control, it doesn't matter if you're 30, 40, 60, or 80. If you want to access that cash value, you can. If you were trying to get a line of credit on your home equity at age 75, the bank is going to ask you some questions, right? Because you're probably not working at that point, and they probably aren't going to give you a line of credit.
Yeah.
But
Yeah.
if you have access to your own money, no one's going to tell you that you can't access it, right? So it's a
Right.
huge, huge benefit when it comes to just control and accessibility.
Yeah. Awesome.
Mhm.
Well, Lesley, it's almost time. We're 28, 29 minutes in. So
Okay.
I just want to thank you for taking time out of your very busy schedule to share on Wealth Strategies to Value podcast. And I want to also congratulate you on being able to see a valuable benefit in this and make this amazing transition from IT over to a financial strategist. You know,
Yes,
and
thank you.
I just appreciate you bringing some information and knowledge on the infinite banking concept to Wealth Strategies to Value. And our motto here is to basically we want to make sure that people are financially literate, and we want people to live a happy, a safe, and a much more enjoyable retirement. Hey
Yes.
guys, thanks for tuning in. Until next time. Bye bye.